Weekly stock market update. Are you ready for this? It's important and exciting. Let's get right into it. Okay, here we go. $34 is what you're paying for every dollar of forecasted profits in Microsoft. But that is a measure of valuation. Valuation is not the only thing that moves stock prices. What's cheap? Energy. Well, where would you rather put your money? In, I don't know, Nvidia, Broadcom, Apple, Alphabet, Meta, or energy stocks? You might say energy stocks. Well, actually, you need to do a bit more research than that. Valuation is not the only thing that moves stock prices because growth, for instance, is also relevant. However, it's important to look at value because it is an important component, and we'll look at some of these stocks going forward. In the week ahead, there's nothing which is going to move the markets from an earnings perspective. There's no important companies giving earnings announcements. Where are we on this? Remember to watch this video on landscape mode. Turn your phone sideways if you need to. Okay, now that's the 0% line. You can see which sectors are doing particularly bad. Real estate, for instance, most of those companies are on this side of there. Which ones are doing particularly well? Well, I'd say communication services. That includes companies like Meta Platforms, for instance. Technology, most are on this side. Well, that won't come as a surprise to you, but financials as well might come as a surprise. And industrials like GE Aerospace also. And of course, healthcare, maybe not so much. Maybe that's 50-50. I don't pick based on sectors. I pick based on companies. So I don't care which sectors happen to be doing well. I've had a busy week. This all happened in the space of 1 week. Okay, we did some political hustings. We did the UK-India awards. I was moderating the hustings. Value growth, income, cash return on capital invested. These are all incredibly important things to look at. You need to tick every single box when you're picking stocks. If you do not, you will know why your pension fund is underperforming and why your IFA is underperforming, because they will try and shove you in things which only look at one thing, like only at value or only at UK stocks. We go through 10,000 companies to make sure they cover valuation, growth, dividend, yields. And if you want to know how much of an idiot your financial advisor is, and feel free to embarrass them, just ask them, why do you not look at the Sortino ratio? It's really simple. It's a good way to cheat with the stock market. What it shows you are companies which tend to have higher average returns and fewer drawdowns, and the drawdowns recover rather quickly when combined with the alpha. They won't look at either. If they do look at alpha, they certainly won't be looking at Sortino because they weren't well educated in the right materials. That's a ratio from my industry, the hedge fund industry, where the clever people go rather than the retail fund managers. Sorry, it's painful for them to hear, but it is the case. Okay, Croaky comes from Goldman Sachs Wealth Management. Over the past week, this is what's happened. You can see there's been some greens. Okay, we'll have a look at Nvidia and Broadcom, Micron, Qualcomm, why some of those have come off and where the opportunities are with momentum, because that's a measure of momentum, what you're looking at, and say some of the undervalued ones like telecom services, energy as well. We're not going to trade our investments. We're looking to hold them for about 12 months, but it's certainly worth looking at what's happening each week in case there's anything we're missing. Exchange-traded funds, well, crypto keeps getting a bit of a hit and a smack. I'll talk about leverage a little bit later on. I still have my 2 times leverage in Microsoft, Apple, Amazon, Alphabet. Okay, year to date, where are we? That's the NASDAQ. It's up 17%. Now, this is really important for you to know what good performance looks like. What does 17% look like? Well, starting here in January, you have delight, despair because it goes down, you lose all your gains, and over 6 months, you've got nothing to show for it, or 5 months, you've got nothing to show. And then delight again. You're still up 17%. So what does a 17% rise look like when the market hits an all-time high? It looks like making money, losing it all, and then making it. Now, you might think, oh, well, that's easy to do, Alpesh. No, most private investors, even if they got in January, will have by this stage got very excited. When it got to here, they will have exited, taken nothing. And then when it rose, they thought, oh, I'm missing the boat and get in too late. And that's typical of what happens, and we want to avoid that. That's why we look at a 12-month period. And we also look at when we don't need to worry about this. If they're a baby bear, which means falls which we can ignore, or a mama bear, which are largely falls we can ignore as well, then we know, well, it's fine. it'll come back. One of the reasons I don't look at sectors as such, although you can see which sectors have really been leading the way this year, and it's consumer, energy, utilities, tech, energy, utilities, financials. However, think of these like horses in a horse race. I don't want to bet which ones are going to win. I want to look at the companies individually and say, right, I want these stocks. And if they happen to be in communications, brilliant. If they happen to be in tech, great. Okay, that's the way it works. Equally, when it comes to styles, I'm not going to gamble on this. This is why IFAs and pension fund managers try and flog you momentum funds or value funds or growth funds, because what they're hoping is they'll have enough marketing collateral to say to you, look, some of yours went up, I know all these went down. Well, actually, that spray and pray approach isn't good. What you want to do instead is say, well, I only want companies which meet growth, value, income, all of these factors. So that for that, I need a large number of companies, 10,000, not just those from one geography like the UK, and I want ones which tick every single box. Tell me what I'm doing wrong. Okay, we're ticking every single box. Now you might say, well, you're missing all the companies which are massively speculative, which might be absolutely destroyed, but hopefully somebody will do a meme on them, or somebody will do a takeover bid. Yeah, you're right. Those kind of crazy speculative Vegas stuff, I am ignoring. I don't want. 1 year, and you can see it again. Delight, despair, delight. Okay, 34% on NASDAQ. Call your IFA right now and ask him, why over the last 12 months am I not up 34%? And you will get periods like this. You're delighted. And then after 6 months, you've got nothing to show for it. Okay, or 4 months or 5 months. And then you get a rise, goes back again, goes up. So we need to ensure we've got a strategy for being able to determine what those are. Are they baby bears, mama bears, or daddy bears? Daddy bears, are you going to cash? 2022, for instance. Most times you don't need to do that. Most times they are baby or mama bears, and you just don't need to do anything about it. I've written articles about this. My book's over my shoulder. Don't use that terminology, but describe the same phenomenon. Those labels I've just decided to add recently. FTSE 350 over the past month. These are what they've done. Okay, S&P, I'm very pleased with how that's going along. And I'll give you an example of a baby bear. See those falls, which over a month, each one of those bars is 1 week, happened over 4 weeks. We didn't need to worry because the monthly MACD was rising. That is the definition of a baby bear. Can ignore it. What's a mama bear? One of these where you might take some money off the table. It's where the monthly MACD is falling. What's a daddy bear? Where the monthly MACD is falling and crosses below its own moving average as it did there. Then you want to be in cash. Okay? When daddy bear's in the house, get the hell out of there. All right? You want to be in cash. Mama bear, if you're risk averse, you might take 30%. You might sell off just in case mama transitions into a daddy. Otherwise, if you're more risk loving, you just ignore it. And baby bears, we should all ignore. All right, simple as that. Otherwise, you'll end up getting out of the market too quickly, and you will start trading your investments, and you'll mess things up. Right? Good. NASDAQ, similar to that. Now, the other lesson I have to teach you about these things, particularly with the NASDAQ, is, or actually any stock, drawdown depth. What was the peak to trough drawdown historically in an upward trend? If you don't like it, then don't be in it. And duration to get back. Now, you can work out your risk appetite and what it is by having your drawdown depth and durations. It might be 20% and 4 months, in which case you're more risk averse. If you're more risk loving, it might be 30% and say 8 months. What's the difference between these two? Do these people make more money? No, they don't, even though they're taking more risk because they're willing to take 30% drawdown depth. These people have more choice of things to pick from. So don't worry if you're tight. By the way, less than 20 and 4, it's going to be difficult to find anything for you other than index, okay? Which means if you are in 20 and 4, then you probably want an exchange traded fund. Part 2 coming up very shortly on separate video where I'll go through this and this. So watch out for part 2.